The 2015 Intergenerational Report provides that Australia is heavily reliant on personal and corporate income tax revenue. This is set to increase, which may impose serious costs in our economy. Restructuring our tax system can assist in making Australia a more attractive place to invest, which will boost economic growth.
Australia's company tax rate is 30%. This is one of the highest rates amongst OECD countries. This should result in more tax revenue. However, it actually operates as a disincentive for companies and can lead to tax minimisation practices such as profit shifting.
Profit shifting is the process of a company artificially lowering their profits in one country and increasing their profits in another country, so that they have less tax payable in the first country, where the tax rate is higher, and more tax payable in a country with lower taxes.
Apple has recently come under scrutiny over allegations of shifting their profits made from Australian sales to Ireland, where the company tax rate is only 12.5%. An investigation by the Australian Financial Review found that over the past 10 years, Apple have shifted $8.9 billion of profits to Ireland. As a result, almost $9 billion of revenue from sales in Australia from products created in China from a company originated in America is being taxed in Ireland. Apple is not alone. These methods are technically legal and are common for multinational corporations.
Many people are calling for companies who avoid tax to be named and shamed by implementing greater transparency measures. This was recommended by the current Senate committee inquiry into tax avoidance, which suggests that companies being publicly accountable for their actions is key.
In 2013, Starbucks faced a consumer revolt in the UK after they were publicly exposed for only paying tax once in 15 years. Mass protests and boycotts led to Starbucks making a voluntary tax payment of £20 million.
Another suggested approach to stop profit shifting is to lower the company tax rate. This approach has been endorsed by the Tax Institute, who suggest that lowering the company tax rate to 25% would make Australia a more attractive place for investment and deliver economy-wide benefits, including increased employment, wages, and ultimately tax revenue. However, lowering the company tax rate will be costly in the short term due to the immediate fall in tax revenue, but there are several sacrifices that can be made in the short term.
Under Australia's current tax regime, billions of dollars of potential revenue is being lost overseas from profit shifting. A combination of greater transparency measures and a reduction in the company tax rate would make companies publicly accountable for their actions and render Australia a more attractive location for investment. These solutions would undoubtedly improve Australia's current tax regime and ensure sustainability for the future.